Welcome back, everybody. In today's video, I'm going to continue showing you the investment strategies that I use to manage real money for real clients. We're going to tackle two of my satellite strategies, specifically my cryptocurrency strategies. I know you all been waiting for this. So yeah, crypto, one of the most disruptive and exciting asset classes to emerge in the 21st century. And be sure to stick around because not only are we going to discuss my crypto models, we're going to discuss crypto custody, crypto allocations, and why I believe crypto belongs in your portfolio. I'm David Warshaw, certified financial planner at the Wealth Plan LLC, and today we're tackling crypto. Okay, so I've been a long-time crypto investor and enthusiast. See, I got my little Bitcoin sign in my office. Honestly, it's been one of my best personal investments and also one of the best recommendations that I've ever made to my clients. I'm just going to show you my cards now. I'm extremely bullish on blockchain and digital assets, cryptocurrencies, whatever you want to call it. I'm definitely in the camp with the Cathie Woods and the Tom Lees of the world, where I believe one day we'll see Bitcoin at $1 million a coin and Ethereum at $10,000 a coin in the years ahead. But let's say you're not a true believer yet. You're just not sure. Why should you even consider owning crypto as part of your diversified portfolio? Well, here's a few reasons why you may want to give this asset class a second look. One, crypto gives investors exposure to blockchain technologies, one of the most transformative technologies since the internet itself. Two, the upside is asymmetric, meaning your potential gains are far bigger than your potential losses. You put 1 to 5% of your portfolio into crypto. If it goes to zero, the damage is limited. But if it succeeds, and I do believe it will succeed, that small slice can move the needle in a very, very big way. Love asymmetric investing. Three, crypto also adds diversification because it doesn't always move in lockstep with stocks and bonds. Four, Bitcoin in particular can act as a hedge. Think of it as digital gold, protecting against inflation and currency risks. Five, remember, we're still in the early innings. Allocating today gives you a front row seat before institutional adoption makes this investment go fully mainstream. Realistically, we're already seeing it with ETFs and other asset managers entering the space. And six, crypto is a truly global asset class. It trades 24/7, 365, it's borderless, and it's accessible to anyone in the world. Now, for my clients at the Wealth Plan LLC, I run two different crypto strategies. The first one is called the Crypto Core model, and the second model is called my Crypto Explorer model. Now, the Core model holds 80% Bitcoin and 20% Ethereum. And I built that just by looking at what the crypto market is today. If you strip out all the other altcoins, that's the actual allocation today. 80% Bitcoin, 20% Ethereum. The goal is clearly long-term capital appreciation with a buy and hold approach. Crypto is always buy and hold. Now, the Explorer model is a little bit different, a little bit more adventurous. It holds my favorite altcoins today, including Solana, Chainlink, and Sui. The benchmark here is my core model, and I update this portfolio at the very least annually. For research, I partnered with my friend Kevin Tang, the former director of digital assets at BlackRock. When it comes to crypto, two heads are definitely better than one. Thanks, Kevin. Now, for suitability and risk tolerance, both of these model portfolios are only suitable for ultra-aggressive investors who can stomach big swings. Crypto is so volatile that it makes the stock market look kind of boring and tame. And let's be clear, you only invest in crypto what you're willing to lose. If blockchain tech ever got stale, or if encryption was broken by something like quantum computing, the entire ecosystem could be at risk. For the crypto core model, I prefer using crypto ETFs. They fit neatly into your brokerage accounts like Schwab, Fidelity. They're regulated, convenient, and they can even sit in your retirement accounts like traditional IRAs and Roth IRAs. And as I record, it appears as if crypto may even be showing up as investment options in your 401k plans soon. ETFs make crypto simple. No wallets, no private keys, no custody. And I believe in the near future, we're going to see ETFs for all the major cryptos in the top 20. making this even easier for investors to allocate to. But for clients who want to own crypto directly, I've partnered with BitGo Wealth Management. Based in Palo Alto, California, and founded in 2013, BitGo is the gold standard for crypto custody. They safeguard over $100 billion in assets, and they've never been hacked. That's like a really big deal. Super big deal. Investors get peace of mind knowing their assets are held in a bankruptcy remote entity, secured in bank-grade vaults with armored guards, stored in cold storage facilities, and backed by an insurance policy covering theft or hacks with defined limits, all with institutional-grade security and legal protections. So I'm really excited about my BitGo partnership. Now, when it comes to implementing your crypto investing, you do have some other choices. You could use software wallets, hardware wallets, regular exchanges, or a company like BitGo. Now, each of these storage methods has their own pros and cons, which we're going to get into. But I'm just going to tell you that after years of research and experience, I feel BitGo is the preferred choice for clients who want true ownership, security, and flexibility. Let's compare, shall we? Software wallets like Exodus or Atomic are convenient apps you could download on your phone or computer. You control your keys, which is a huge plus, but they're still connected to the internet, making them vulnerable to malware, phishing, or hacks. They're more user-friendly than hardware wallets, but still put all the responsibility on you. Now, hardware wallets, on the other hand, like a Ledger or Trezor, give you control, but everything, once again, rests on you. One single point of failure, your seed phrase. Lose it, damage it, or it gets stolen, and your money is gone. No backup, no insurance, and let's be honest, the interface is pretty clunky. Now, exchanges like Coinbase are great, they're convenient, beginner-friendly, but you don't control the keys. And unfortunately, as history has shown us, FTX, Mt. Gox, Celsius, Voyager, these exchanges can fail and go bankrupt. They can freeze withdrawals. They can get hacked, leaving clients stranded with little to no recourse. You're left being the creditor of the organization. BitGo Wealth, on the other hand, gives you the best of all worlds. Assets are segregated, insured, and legally protected. Remember, if something happens to a company like Coinbase, your assets may not be protected. It may not be bankruptcy remote. And as you can see here, BitGo provides institutional-grade security, some of the best I've seen. Your advisor can trade 24/7, 365, and you actually own the crypto directly. Plus, BitGo helps avoid the wash sale rule for tax loss harvesting. It allows in-kind transfers and eliminates potential ETF tracking error. And it comes with a modern, intuitive interface that looks and feels more like your regular brokerage accounts. Now for the fun part. Let's analyze some portfolio metrics using my Koifin investment analytics platform and Perplexity AI. That was a mouthful. Well, all right. That was my Matthew McConaughey impression. We're looking at the crypto core model here that I use for clients who want to own their crypto in ETFs at Schwab. So let's take a look here. There's no yield on this portfolio. Expense ratio is 0.25% a year. Once again, 80-20 split between Bitcoin and Ethereum. Now, if you look at the ETFs I'm currently using in this model, and of course that's subject to change because there's a myriad of Bitcoin and Ethereum ETF options, you see that Bitcoin was incepted January 5th, 2024, so pretty much most of 2024, and the Ethereum came out in the middle of the year, July 24th. When you look at the returns, at least of this model, in 2024, it was up 27.45%. So we do have a full calendar year return for 2024, but we know one of the holdings didn't exist for, a little over half the year. And 2025, it was up 32.19% as I'm recording this video. So we don't have a tremendous track record when it comes to these crypto ETFs. But rest assured, we will obviously have a much better idea of how these perform relative to owning Bitcoin and Ethereum directly. Now, since the inception of these ETFs, the max drawdown is 36.45%, but that doesn't tell you the whole story. Now, Bitcoin came out in 2009, and the max drawdown Bitcoin experienced was 93.18%. That happened in 2011. That is a brutal drawdown. Now, Ethereum was first launched in 2015, so I just wanted to look at, well, what did this portfolio do from 2016 to 2024? The max drawdown was 54.87%. And using Perplexity AI, seeing the performance of an 80-20 Bitcoin Ethereum portfolio, I mean, the returns are just really stellar. 249% in 2016, 2,974% in 2017, down 75% in 2018. Ouch. Up 73% in 2019. I'm clearly rounding. Up 336% in 2020, up 127% in 2021, down 65% in 2022, up 142% in 2023, up 106% in 2024, and up 15% in 2025. So just some really mind-boggling numbers on the performance front. Now for my Crypto Explorer model, one of the coins is very, very new. It came out in 2023. So stripping that out, I can only go back as far as 2021 because a lot of these cryptos are newer. But if we equally weighted this portfolio, which the portfolio is not equally weighted for full disclosure, but if we were to equally weight it, it would be 74.63% in 2021, down 54.57% in 2022, up 95.92% in 2023, and up 6.77% in 2024. And like I always tell clients, whatever you allocate to crypto, just assume it's gone. Don't think about it. This is a very volatile asset class, very speculative, and like I said, anything can happen with the underlying technology. So for my clients and you, valued viewer, I strongly advise to leverage the ETF products and a platform like BitGo. Ultimately, I think they're both the superior solution when you factor all the risks that exchanges, hardware wallets, and software wallets pose these days. Now, a common question I get is, okay, this is great. I want to allocate. How much should I put into cryptocurrency? Now, from an asset allocation standpoint, I recommend 1 to 5% of your portfolio should be in cryptocurrency. If you're the kind of investor willing to seek out greater returns given the risks involved, like myself, allocate more. That's totally fine. Just be disciplined with your asset allocation decision, as that is one key to successful investing. Take care. Bye-bye.